Hello, everybody, and thank you for joining me today. It's Allan Barry Laboucan with the Rocks and Stocks News Show. Got a couple of companies to talk about that had really good news out today. And then at the end, after that, I'll talk about some trends that I'm quite excited about. So let's get right into it. The start here, the first company that I wanted to talk about is Heliostar. Heliostar to restart mining operations and invest in growth at its San Agustin mine in Durango. The highlights of the news are mining operations to restart at San Agustin in the second half of 2025. So we're right there now, with initial production expected in Q4. Operations analysis supports a post-tax NPV with a 5% discount of 35.25 million, an IRR of 548%, a minimal capex of 4.2 million, and an output of 45,000 total gold ounces produced at a $3,000 per, or produced at 3,000 US dollars of gold. So that's the number that they use in the analysis. It's a little under the current price. A restart provides confidence for the first significant Heliostar investment in the future of San Agustin, aimed at extending mine life. Drilling will commence immediately in H2 2025 on oxide expansion targets, followed by sulfide porphyry breccia exploration. So they've been mining the heaps, some stockpiles, and now this will get them the ability to bring on fresh rock to process. And wow, that's a really beautiful IRR there. So they talk about pleased to announce restart of mining at San Agustin. It's in the state of Durango, really well-known state for mining in Mexico. They presently produce gold from residual leaching at the San Agustin mine. So that's material that's already on the leach pad, and now this will give them fresh rock. The company will increase production by mining the mineral reserve, principally in an area the company describes as the corner area. This is a milestone to unlock increased value from San Agustin. Charles Funk, who's the CEO, stated in the news release, and I quote, Heliostar is pleased to have met its forecast timelines to recommence mining at San Agustin. Mining the corner area will produce 45,000 ounces of gold from the current reserve. It will generate 40 million in cash flow at 3,000 gold price. Heliostar has made this restart commitment, having complied with all the requirements to start mining and having approximately $30 million in cash on our balance sheet to fund the necessary capital. As it goes on, as the largest local employer, this milestone provides job stability and provides for expanded economic opportunities for our nearby communities and throughout the state of Durango. For Heliostar, it marks a shift from the residual leaching to active mining, increasing production and improving cash flow through 2026. It also provides the confidence to begin new investment growth in San Agustin. This will include drilling aimed at converting oxide resources to reserves and testing sulfide targets that share characteristics with deposits such as Penasquito and Camino Rojo, end quote. I like hearing those two names because they're in the state of Zacatecas where I live. Penasquito is a great mine, and so is Camino Rojo. Camino Rojo is actually operated by one of my picks, which is Orla Mining, and they've done tremendously well at that. So encouraging to hear those two great mines as analogs. They go on technical report summary. They have filed a amended and restated technical report titled San Augustine Operations Durango. So you can take a look at that if you want to see the 43101 technical report. The life of mine plan set out in the technical report indicates a probable mineral reserve of 68,000 ounces of gold can be exploited over a 1.2-year mine life at an all-in sustaining cost of US $1,990 per ounce. The initial capital cost in the technical report is estimated at only $4.2 million US. They go on with more details about the technical report and the reserve estimate. So, and it's really only a small portion. This is what they call the corner area, and looking to the southeast, showing the current reserve model and planned pit shell. So that would be this entire thing. And as you can see, it was just part of a larger pit that they're expanding on. Restart steps. In 2022, previous operator of San Augustine Mine reached a private surface rights agreement to access the portion of the deposit referred to as the corner area. Despite this, mining operations ceased at the mine in late 2023 due to a lack of permit accessible mineral reserves. So now they got that handled. In July 2025, Heliostar complied with all required applications and received the required approval to undertake this open pit expansion. The relevant application was submitted in Q4 2024. Further, the company has, that's not too long ago, so that was a pretty good turnaround. Further, the company has also received a variance to its environmental impact assessment to increase the height of the San Augustine leach pad, leach pad to from 77 to 88 meters in height. This variation will save approximately 5 million in capital. Their restart plan will include selecting civil drilling and mining contractors, moving of a power transmission line, establishing additional access roads on site, removing and stockpiling the vegetation and topsoil. The work is anticipated to be undertaken in Q3 and Q4, so we're talking about right now, allowing for the first stacking of new ore and subsequent new gold production from the corner area in Q4 2025. And here's the exploration stuff. I always love getting into this. The restart of mining at the corner area expands the mine life at San Augustine with the longer production timeline and confidence in the ability to convert resources to gold production. Heliostar will commence a drilling program seeking further mine life extensions. The immediate focus for growth is on near-surface oxide material that could be processed through the existing facilities. The company recognized several growth targets at the margins of the current pit and at the edge of the corner area reserve. Higher grade oxide results from the priority corner southwest target area include they had a drill hole there, 196, which was 3.52 grams per ton of gold over 18.3 meters from 32 meters downhole. And hole 177 grading 0.34 grams per ton gold over 15 meters from 27.4 downhole. The targets are extensions of the mineralized corridor divided by grade control drilling and through a comprehensive relogging and multi-element reassaying program undertaken by Heliostar's geologists in H1 2025. The higher gold price environment has also increased the potential of certain lower grade areas that were not previously a focus at St. Augustine. So, yeah, this is a phenomenon that I think we're going to see a lot of. In the past, you would look at certain grades with gold much lower, and that wouldn't make the grade, if you will. But now that gold is at 3,400-ish and looking like it can go higher, well, that makes very good sense for a lot more material these days. Here is where they highlight some of the drilling and that expands that pit. Uh, Plan map of San Augustine showing oxide gold growth targets with drilling and blast hole data shown. So yeah, there's more to be added here. This is interesting. The sulfide exploration targets. San Augustine is a very large mineralized system that hosts a significant volume of gold, silver, lead, and zinc mineralization immediately beneath and adjacent to the current pit. This mineralization is not amenable to conventional heap leaching, and metallurgical work undertaken by the company has indicated grades are not high enough for economic extraction at present prices. However, higher grade results have been returned from within the sulfide domain at San Augustine, including hole 133, which graded 0.49 grams per ton of gold, 25 grams of silver, 0.2% lead, and 1% zinc over 297 meters from 16.5 meters downhole. Then another hole they highlight here. So this is interesting. I'm going to have an interview with Charles Funk tomorrow, and I'm going to get into this. The news release goes on. It's similar to Central Mexican gold-rich polymetallic intrusive related deposits, including Penasquito and Camino Rojo, also contain higher grade zones of gold and silver mineralization, demonstrating the potential for defining high grade mineralization within the San Augustine system. Investors are cautioned that mineral deposits on other properties are not indicative of mineral deposits on the company's properties. That's your standard disclosure. They're just looking at it for a comparison, but they have to put these disclaimers in there. In H1 2025, Heliostar geologists built the most detailed geological model completed to date of the San Augustine deposit. This model proposes that the bulk of the gold and silver mined to date is from an intermediate sulfidation vein system that sits above intrusive related breccias and the southeast of an interpreted intrusive breccia center that is believed to have a porphyry source. Very interesting. So I think that's got some sex appeal to it for an exploration guy like me. The interpretation generated four significant new porphyry breccia targets beyond the previously drilled mineralization. These four zones are adjacent to and northwest from the San Augustine pit. These targets are supported by geology, alteration vectors, geophysical signatures, and significant geochemical footprints. The company believes that they have strong similarities to those at the Penasquito deposit. Upon completion of the oxide drilling, the company intends to test these new sulfide targets, looking for high-grade mineralization at San Augustine. Interesting stuff. They talk about silver veins. 1.3, wow, 1.3 meters at 3,235 grams per ton of silver. So that would be very high grade epithermal veins, 2.85 grams per ton of gold, 15% lead and 8.7% zinc. Wow, that's in a 1987 hole. Wow. And this also shows silver in rock chip samples. I'm surprised that nobody's ever followed that up. That looks like a classic high-grade epithermal vein to me. I mean to talk to Charles Funk about that. Uh, they talk about the history, 2021, large claim block. Previous operator acquired it from Fresnillo PLC to support an expansion of the open pit, which increased the San Augustine land package to 5,884 hectares. Since then, no significant regional exploration has been undertaken on these acquired claims. The regional exploration targets at San Augustine include the Canseco vein prospect, last drilled in 1987. These veins include intercepts such as 1.3 meters grading 3,235 grams per ton of silver. So that's 3 kilos of silver. I mean, you could build a mine with the stuff that's on the right side of that comma. 2.85 grams per ton of gold, 15% lead, 8.7% zinc on Consejo de Recursos Minerales, 1985. There have been no drilling on these veins since the initial government program 38 years ago. Heliostar will undertake a modern sampling and target generation program focused on these veins and across the broader claim package to define additional drill targets in H1. And then they talk about the qualified person not able to independently verify the assay results. It's your standard disclaimer, but um, uh, Charles Funk is an extremely talented exploration guy. So I'm sure he's going to get after this in a big way because those are juicy numbers that any exploration person would get really excited about. So there you go. That's the news from Heliostar. And as I said, I'm going to have an interview with Charles Funk tomorrow. I'm really excited to talk to Charles about this. I've done interviews with Charles in the past, and they're building a junior gold miner that I think, and I'm sure they do as well, is focused on growing into a mid-tier. And they certainly got a lot of really great projects. And earlier today, I heard Charles talk about the other work that they're doing. So I just wanted to deal with this news release today on this show. And tomorrow we'll get into more of the stuff that he talked about in a video I saw of him talking about this news release. So stay tuned for that. I'll have it out tomorrow. All right. Now, Nuvau Minerals. This is a very exciting news release. Nuvau's gold-focused exploration program underway at Matagami. They talked about their gold-focused exploration project at the Matagami property. Now, to put this into context, Matagami is a very large land package, 1,300 square kilometers. And they got it from Glencore. And Glencore had been mining on this project until 2022. Now, Glencore is a major, so they have some very major projects, and they made this project available to Nuvau for to option it and earn I think it's 100% interest in it, and but the project, although it's in the Abitibi region of Quebec, and that's well known for big gold mining, this project had never been explored for gold. So now they started, and off their first hole, they had some very good results, and I'll get into that. So they talked about at gold focused exploration at the Matagami property. where the first hole drilled intersected what appears to be an orogenic low gold system close to the Bracemac McLeod mine in Matagami. Again, this Matagami project is well known as due to the base metal exploration that or mining that Glencore did. Assays are pending after Nuvau intersected visible gold in a structure intersected in the first hole. Then Peter Van Alphen, who's the CEO, and I interviewed him last week, he stated, and I quote, "We are extremely encouraged by the success of the initial hole of our maiden gold-focused diamond drill program on this 1,300 square kilometer land package. The footwall rock units where this new vein intercept occurs is in a largely untested part of the property in an area not deemed favorable for base metal mineralization. In addition, this mineralized zone is located less than 25 meters from the mine's access ramp at the permitted Bracemac McLeod mine." End quote. They go on the steeply dipping, strong shear zone structure with quartz veining mineralized with pyrite and locally visible gold was intersected at a depth of approximately 200 meters below surface. Although it is within footwall stratigraphy of the past producing Bracemac McLeod mine, the area has been seen very little drilling in the past as it was not of interest for VMS type exploration. Planning is underway for the follow-up drilling, which is expected to begin within the next 2 weeks. I imagine they're excited to get in there. So you can see the access ramp, and it's literally right beside that access ramp. And it's a historic vein in the, or sorry, historic vein in the ramp 45 meters apart. So it's literally right beside that access ramp. And because the Bracemac historic VMS deposit, which is right here, that's what they were mining. They weren't interested in gold. They were interested in the VMS deposit. But sitting right beside that, in the access ramp and infrastructure, is this hole that they drilled. And on their first hole, look what they found. Um, oh yeah, this figure one is the past producing Bracemac McLeod mine and the relative position of the gold target drilled. So yeah, 45 meters from the underground working is where they hit this. And here is some images uh, of the visible gold. So you got it there. Then they have a more close up, and you can see, look at there's a lot of visible gold in there, and some of it's chunky visible gold. So it's not just one or two specks of fine grain gold. You're actually looking at some coarse grain gold or more coarse grain gold here as well. And there's a fair abundance of it. Here again, you've got, that's a pretty good sized chunk of visible gold there. Oh, sorry, okay. So here you can see it in closer. So yeah, look at that's some nice looking visible gold, especially to think it's in the first hole that they ever drilled for gold exploration. That's amazing to see. Hole number one. As it says here, visible gold found in more than 30 gold chips identified in logging the core. So here again, you can see it, and then they magnify it a little bit. But then look at that's a pretty good amount of visible gold right there. The Matagami has hosted numerous base metal mines over the last 60 years. However, previous owners never applied a gold-focused exploration program to its large-scale property, even though it is strategically located in the Abitibi geological subprovince. The property is located in the Abitibi region of Quebec, one of the world's most productive gold districts. It includes Canada's largest gold producing mine with the country's largest gold mineral reserves. The Detour Lake mine, or they're talking about the Detour Lake mine there. Detour Lake is owned by Agnico Eagle Mines, located west of the Atagami. So it's over here, and here's in blue is the Matagami project. The Casa Berardi mine, which has produced over 3 million ounces of gold, is also located just southwest of the Matagami property. So here you got Matagami. So that's 1,300 square kilometers. Now, when you're looking at orogenic gold deposits, these are big, deep crustal structures. This one's called the Sunday Lake Deformation Zone, and this is the Abitibi, or the I forget the name of it. But what's important is that this project is sandwiched in between these two structures. So why that's important, folks, is orogenic gold has very deep roots. The source of where that came from can be down thousands, 10,000 meters below surface. And in order for that gold-bearing fluids to make their way up closer to surface, the path of least resistance is these deep crustal faults or structures. All right. And then when it gets closer to surface, secondary faulting is also important. So they're in the right age of rocks, they're in the right kind of rocks, they're in the right kind of structural regime, and importantly, they have found quartz with visible gold in it. So it's got all the check marks of a exciting discovery in the Abitibi. So as I mentioned, Detour is way over here, Wallbridge is here. This Selby mine is a VMS mine, Abitibi B26. That's a base metal as well. Hecla's Casa Berardi is over here. So yeah, it's got all the hallmarks of what you look for for an orogenic gold system. And it certainly looks like that's what they hit with their very first hole and lots of visible gold in it. Very impressive to see that much visible gold in a discovery hole on a brand new target on a huge land package in the Abitibi. This is getting very exciting, very quick. I did an interview with them just last week, and so very timely interview, I might add, because the stock is up quite significantly on this news. And so, yeah, it's great stuff. I love new discoveries. I love to see high grade or uh, um, drill holes with this much visible gold in it. And those are off for being assayed now on Nuvau's brand new gold discovery in the Abitibi on a huge project, 1,300 square kilometer project that was mined in the past for VMS deposits. And now it looks like they've got an orogenic gold discovery there. So that's super exciting stuff. As you can tell, I'm a little pumped up by that news. All right. So those are the companies that were in the news today. I'm gonna get into some charts here because I'm seeing some very exciting stuff. And So in my show yesterday and on the weekend, today's Tuesday, on the weekend, I talked about what I was seeing and why I thought copper was let's start with gold. So what I had talked about on the weekend was this basing period here on gold, and that it was getting into a very tight range. And I thought that it was ready for a significant breakout. And that was here. And then on Monday, we got that significant breakout. And what I'm looking for next for gold is it to get above this all-time high of 34.72. As I'm speaking, this is the futures chart. As I'm speaking, it's at 34.39. So what I'm looking for is it to break out above this high close here and get into new record highs. You know, I think the fundamentals of what drives gold is the I call it the death spiral of debt that's made worse by the cost of servicing that debt. The central bankers have been buying a lot of gold over several years now, especially in the last 4 or 5 years. And I think a lot of that has to do with the death spiral of debt in the United States and in other countries. Ultimately, I think that the fiat currency and debt system globally is broken, and the best and safest place to put your money is in gold because I think that this broken fiat currency system and debt system is going to ultimately drive the world back onto the gold standard. The BRICS nations are already doing that. Their central bankers have been buying gold, and they bought so much gold that now gold has a higher reserve than the euro, and even is making inroads against the US dollar as a reserve currency. The US dollar has fallen from about 60% of the reserves by central bankers to now under 50%. So not only has gold surpassed the euro, it's making inroads against the US dollar as well. So tons of bullish reasons to be bullish on gold. And I think that's what's going to drive it into new record highs, uh, and this short-term trend as well. All right, so let's go to silver. Silver's made a phenomenal breakout back here above $35. This was a sort of a roof, if you will. See it hit it there, and now it's significantly broken above it, and only 35 cents on the futures from $40. I think that once it breaks through $40, it's got easy sailing to the all-time high of $50. And then I think it will follow a similar path as gold, which has made over the last year a series of record highs in the price of gold. Someone calculated, I think it's like 70 record highs since it broke out above. Actually, I got to go to this chart to show you the big breakout. The big breakout was here when it broke above. It had sort of got above 2000, and then it didn't get above 2100. And then when it did, it's just been record highs after record highs. So let's go back to silver because I think that's what's going to happen for silver. Once it gets to that $50 all-time high, then I think it makes a series of record highs. And I think that's what's ahead of us in 2026 is a series of record highs. And this is the foundation of making that move to $50 and beyond. Copper, of course, it's also making a record high. Uh, Today it got up to $5.77 on the futures. And yeah, this big move here happened because Trump announced that he wants to put a 50% tariff on copper coming into the country. I don't think he's going to follow through with that, but what he did cause is for people to be aware of how tight the supply is for copper. And this action here with the big spike, and then since then, I believe is US end users positioning themselves in copper just in case. But even the just in case action has caused people to realize just how tight the supply chain is. Now, I was talking about the potential for this breakout before this all happened because we've been hearing for the last couple months about the smelters having problems getting enough material to refine for copper. And so that just goes to show you how tight the supply is, and yet you've got all this demand coming from, grid power in developed countries, building new grids in developing economies. You got artificial intelligence that needs a lot of copper. You've got electric vehicles that need a lot of copper. You got your traditional technology like cloud computing, the internet, all of these things. Now, robots are being talked about. Really, there just isn't enough copper being mined or copper in the pipeline to be mined or new projects being brought on that can meet or exploration has just fallen off a cliff in the last couple of decades. There's just not enough copper to meet all this demand. And so I think copper's going a lot higher. I think it's going over $10 and will stay over $10 in the next year or two. And again, this is a sort of the foundation for that big move. And reason I say that is the weakness in the supply chain, the demand that's coming, and the price that's needed to incentivize serious exploration and new mine development. So, yeah, there you go. Platinum. Platinum is also broken out. Look at that breakout from 988, let's say 1,000. It's now trading at 1,476, and that's since mid-May. All right. So there's strong demand coming from somewhere. Someone's buying a lot of platinum. And the same can be said for palladium. I'm really bullish on this is a classic cup and handle. And whenever I see, you see, the left side of the cup is here at 1225. Then it came down, it created the cup, and now it goes up the right side of the handle. Now, when I see the right side exceed the left side like that so significantly, to me, usually that means that the handle is going to be very short before it's not going to last very long before you see it keep on going much higher. This very well could have been the handle right here. Only a few days of trading to create the handle, or let's say a week of trading, and now it's broken out again. And why I'm talking about all of these metals is that I've recently been talking about in my written report, on my commentary that I do on Twitter and in my private group on WhatsApp, is that I believe we're seeing the start of the next great metals bull market that will be more significant than the 2001 to 2011 metals bull market. And I think we're just in the very earliest days of that happening. All right. So I wanted to make my case of why I think we're started the next great metals bull market. But there's a couple other charts that I want to look at here. And one of those, okay, before I do that, let me go back to gold here. Let me go back to gold. And let me go to the interactive so you can see my 50-day moving average and 200-day moving average. And what I want to highlight here is that you see all of this time that gold has spent above the 50-day moving average since gold broke out in early 2024. All right. So this is your classic bull market trend where the price stays significantly above the 50-day moving average for the bulk of that trend, and the 50-day stays significantly above the 200-day trend line. All right. So keep that in mind when I bring up this next series of charts. So let's go to the 30-year bond because I believe that the ultimate driver of gold is the broken debt system. All right. So this is the price of the bond, and the yield is inverse to that. All right. So right now, the yield on the 30-year is close to 5%. All right. But I think that the bond prices are going to go a lot lower. Now, interesting enough, Trump and Besant and others on his team want the Federal Reserve to lower interest rates. So that would mean that the yield would have to be going down, not up. But if you look at this trend, so it topped here, and since then it's been in correction. During that correction, look at the 50-day and look at it trade below the 50-day. Now it had a rally here in the early part of the new year, but since then it's been in correction again. Now let me go to a longer term chart. Let's go back here to the monthly chart. All right. So as you can see here, the price of the bonds were in a long-term, decade-long-term rally that had the yields and the interest rates down to next to nothing. But then in 2020, it topped, and it's been in a significant correction ever since. Now look at how on a monthly how much it's trading below the 50-day. And it went through the death cross here in 2024. All right, so let's go back. Now we're looking at a weekly chart. So this gives you a better idea of 2020 peak and what it's been doing ever since then. And look at again here. Look at how much it's trading below the 50-day moving average. So whereas gold is in your classic bull market trend, the bond price is in a classic bear market trend. And it's trading the 50-day after this death cross here in 2022. It's been trading the 50-day moving average is trading well below the 200-day. So again, this chart is very contrary to what Trump and his people are wanting the Fed to do. They're demanding that the Fed lower interest rates. And that means that the bond yields have to be much lower than they are now. So if they want lower interest rates, I ask the question, well, you're asking actually for quantitative easing, where the Fed gets in there as the buyer of last resort to manipulate the yield curve so that then you can have lower interest rates. Are they suggesting that the Fed lowers interest rates while the yield is so much above what they want. Trump's talking about 1% interest rates. That's free money area. That would require the Fed to get in there and do a lot of buying and blow out their their balance sheet in order to get the yields on the interest rates curve to comply so that they can lower the interest rates down there. Something ain't adding up here, folks. And this is the same thing in the 10-year. Look at how much it's below for this whole correction. So they go in lockstep. So this whole correction in the bonds, look at how much time the price of the bonds has traded below the 50-day moving average. It also had its death cross. Now, some would argue, I guess, that, well, maybe this is support and the bonds will rally and Trump will get what he wants. 50-year, same thing. So let's go back to the 10-year. So it you would have to argue that either something has to, for Trump to get what he wants, which is lower interest rates, which would require quantitative easing, it would require the Fed to get back in there as the buyer of last resort because the enthusiasm for the bond vigilantes or the bond buyers is wants higher interest rates to justify them buying. And I don't blame them because the US is in $37 trillion of debt. It's got the cost of servicing that debt is now up into it's above the defense budget. To service the debt is above the defense budget. And this recent big spending bill is only going to put more supply of debt out there. So you start to ask yourself, well, who's going to buy all that debt? The Chinese are not buying anymore, and in fact, they're decreasing. The Chinese and the Japanese are the two biggest holders of US, foreign holders of US debt. And they are actually selling. They're not buying anymore. They're selling. And I don't blame them because the politicians, Biden and the left, and now Trump and the right, they're spending junkies. They're addicted to debt. Um, so you've already got massive supply. More supply is coming on. Question starts to be, who's going to buy all that? And especially, who's going to buy it all to get Trump's wish, which is for interest rates to go down 4% from where the 10 or 4% from where the 30-year is. He wants it down about 3.5% from where the 10-year yield is. How are you going to do that? You gotta get quantitative easing going again. You got to get the Fed in there buying. And meanwhile, Trump is just brutally talking about Powell, calling him an idiot, calling him too late, calling him all kinds of names. He may want to be careful because if he wants Powell to 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 get the interest rates down to where he wants them, then he needs Powell to get in there and do quantitative easing. Yes, folks, that's what would have to happen in order for Trump to get his way. Now, he's calling for him to resign. He wants to fire him. He thinks he's an idiot, stupid, and all these other things. All right? But Powell doesn't need to go anywhere legally until next year, May of 2026, or maybe June of 2026. So if he doesn't leave, then Trump's going to need him to get back into building up the balance sheet, quantitative easing. They'll call it something else, of course, But he would need him to get in there and do that in order to manipulate the yield so that they could then cut interest rates. If they do that, the last time when Powell, let's go to the daily, and I'll show you what happened here. So when we go back to September, that this is what happened. The bonds went when Powell made the first interest rate cut after a long period of keeping it higher. You notice the bond prices went down and the yields went up when the Federal Reserve was cutting interest rates. You see where I'm getting at here, folks? Something ain't adding up here. So when the Federal Reserve cut interest rates, the bonds went into free fall and the yields went up when the Fed was trying to cut rates. Okay? So what's going to happen if they cut rates again? The bond vigilantes are probably going to say, yeah, we don't like that too much. That's not a good idea. That's going to cause inflation. That's going to cause the politicians to spend more and create more deficits and more debt. And that ain't good for us bondholders. So, but to then, which begs the question again, for Trump to get his way. How does that happen? What are the mechanics of that happening? The only way that happens is if they do quantitative easing or some call it whatever you want. They got to drive up the balance sheet of the Fed in order to manipulate the yields down so that you can then have the interest rates go down. This again, this ain't adding up, folks. And here's the other thing. So Trump and Bessent and his merry men, as well as Powell and his merry men and women at the Federal Reserve, they keep telling us, oh, the economy is strong. The inflation is moderate. Uh, Everything is Goldilocks. So if everything is great, why does Trump and his team want interest rates down to 1%? You only go down to 1% if you're in a recession or you're heading towards a recession. So again, something ain't adding up here. If the economy is so strong and the inflation is okay, why do you need 1% interest rates? Well, I know why you want that. There's two reasons. One is you're worried about the economy slowing down, and I think the culprit of that is the uncertainty over the tariffs. Oh, apparently tariffs aren't going to cause inflation and everything is hunky dory, but the guys running the CEOs running public companies, they're unable to give guidance due to economic uncertainty. And the consumer confidence is down to where your recession levels. And their concerns about inflation are that it's going to go up over 4%. And so corporate America, corporate Wall Street can't make guidance because of fears about economic uncertainty. Uh, Consumers are equally as fearful of a recession and much higher inflation. And insiders of companies are selling at the highest rate ever. So again, things are not adding up to being so rosy here. And all of those things, I mean, ultimately, those things are very bullish for gold, for silver, Consumers are talking about stagflation, where the economy goes down towards a recession and inflation goes up. Uh, the corporate America is not saying that, but they are saying economic uncertainty. So they're kind of making the case. And, these things tend to cause a self-fulfilling prophecy because if the corporations of America can't make plans and can't talk about their forward guidance on their businesses, that means that they they that in its own could cause a move towards a recession. And so I think that Trump and the folks at the Fed, they might be getting a little, they might not be telling us the truth about what they see happening. And that's why. But there's another reason why Trump wants 1% interest rates. That's because he and Besant see the problem. $37 trillion of debt. Uh, Probably in the next year, the servicing of that debt will be somewhere around $1.5 trillion dollars. And they want to spend more. So that's going to create the even higher deficit. I think it's going to be 3 trillion in the next year. So now you've got a lot of supply of debt, and that's another reason they want 1% rates is because then that will help them on this massive debt problem and get that cost of servicing the debt down. So that's the debt situation. Now let's go in and look at the dollar because this has a big impact on every metal, every commodity. They're all quoted in the US dollar. When the US dollar is down, the price of all commodities goes up and priced in US dollars. And so as you can see now, Trump wants a lower US dollar, so does Besant, because they believe that this will help the trade imbalance. They believe that what will happen is that it'll make their exports more affordable. And but this kind of doesn't make economic sense because the United States is an importer country. Now, of course, they talk about they want more production, more of their domestic, more of what's imported to be made in the United States. That doesn't happen overnight, folks. That's a process that takes years to do. It took 25, 30 years to export all that production and now import the goods. But and if your dollar goes down and you're still importing a lot, guess what happens? Inflation. You know, you can talk about tariffs. Oh, tariffs aren't going to cause inflation. It's the only reason they haven't yet is because there's been the tariffs have not been locked in and they haven't worked their way through the system yet. You watch, there's going to be inflation because of tariffs. Those people that import that stuff and pay when it hits the United States, they're not going to keep eating that cost. The consumer is going to eat that cost ultimately. I don't care what anyone says. They come out and tell me, everybody tells you, oh, no, it's not happening. Oh, no, it's not going to happen. Blah, blah, blah. Okay? But at the end of the day, that is what it is. Blah, blah, blah. Because when those tariffs are make their way all the way through the economy and out to the stores. There was front running of it, so that front running happened. They stocked up a lot, And again, this takes a few months, maybe a couple quarters to really get right through the supply chain and out to the store shelves. But it's going to happen. And so getting back to the dollar. So the argument is by Trump and the Trumpinistas is that they want a lower dollar to increase their exports. Okay. But then you're putting tariffs on everybody that dissuades people from that process. So, okay, we want cheaper. We want a lower U.S. dollar to increase our exports. All right, and then you cause by whatever you import, you get a double whammy lately. You get the lower dollar that doesn't buy you as much from other countries, and then you got the tariff on top of that. This is going to cause inflation. We are coming into the second wave of inflation that, and I think this wave is going to be bigger than the last wave. Okay? That's what happened in the 1970s, which caused stagflation, which I think is already here. So these are all very bullish for silver and gold in a big way. But let's get into let's look at some trends here. All right. So it topped in 2025. Trump's been getting his way. And in fact, this is a very bearish trend that suggests that the US dollar is going a lot lower. Okay. It went through the death cross here, and pretty much this entire time, it has only touched the 50-day moving average twice. Once in May, once here. All right. And look at how much that 50-day. Now, getting back to that, in these long-term bull or bear trends, this 200-day goes down and down and down, and the 50-day stays below it for a long period of time. And let's go to the monthly chart here. And so yeah, here you had a golden cross, and the and so that golden cross on the monthly was in 2017. And for most of that trend, you see, this is your classic chart stuff. For most of this trend, the price of the US dollar stayed above the 50-day moving average. All right. So then we look at the monthly, and we see that it peaked out here in 2022. And it's actually been in a correction for a long time. It had a lower high here on the weekly and a series of lower lows, and now a significantly lower low. Okay, and so let's get back to the daily. So yeah, this tells me you look at the monthly and it's in a significant correction. You look at the weekly, you've got it in correction since 2022, and since 2025, this correction is significantly more than this one before it went sideways and then down. So let's go to the daily. And yeah, this is a very, in a bear market, converse of a bull market, you'll see the price of something, it won't stay in a bear market, it won't stay consistently below the 50-day. It tends to have rallies that go above the 50-day, just like the converse of a bull market, like what we're seeing in the gold price. It it stays most of the time above the 50-day, but it will dip down below the 50-day in a bull market. But you can see here in this bear market, it has only touched that 50-day twice. It hasn't broken through that 50-day once. So I think that this is portending a very steep correction in the US dollar. So on the US dollar, I think Trump and Besant and those others that want a lower dollar to help out their exports and cost them more on their imports, they're going to get what they want. Okay? And that's very bullish for the price of gold, silver, copper, platinum, palladium, any commodity that's priced in the US dollar is about to get much more bullish because of the bearishness in the US dollar. All right. So I've talked about the debt. I've talked about the dollar. Let's now talk about the stock market, the third pillar, if you will, of American exceptionalism. So um, you see here, there was a significant correction because of Trump's tariff tantrum. The Wall Street did not like that. Okay, they don't like it double topped here and then went into a steep correction. This is the Dow Jones Industrial Average. But then everybody on CNBC and all the Trumpanistas and all the bulls on Wall Street talk about, oh, but look at this V. Look at the V type recovery. So it went down dramatically, came right back. But they're not telling you one super important thing. You notice the volume here in these to get it up to these prices, okay? And even in this correction, it was a lot of volume on the correction, a lot, abnormally high volume. Here is the line for the sort of the average volume. Well, it was significantly above that level, okay? And um, then look at the rally. Look at how much the volume has dropped, folks. So a lot of people participated in this action here and in this down move, but their volume has dropped off dramatically on the rally. And that tells me that there's a correction coming. Now, I don't think that the Fed will never throw Wall Street under the bus. They'll come in to try to revive the Wall Street or bail out Wall Street, if you will, with lower interest rates. So Trump might get his wish if the stock market goes into a correction. That's a good way to test old Federal Reserve Chairman Powell there, whether he'll allow if he'll throw the U.S. Wall Street under the bus. He won't. He'll lower interest rates. Toot sweet. If Trump wants, if Trump really wants lower interest rates, a correction in the Wall Street would cause that. Now, it went through a death cross here, recovered rapidly, and went through a golden cross. But again, on very low volume relative to what caused this double top and this bottom. Okay. Now the volume has dropped off dramatically. All right. So this rally, it doesn't have a lot of gasoline in it. The speedometer is showing you're going as fast as you can. The volume is the gasoline. The gasoline is in a little bit of an issue. And so Wall Street moves in tandem when the Dow Jones Industrial Average is moving, the S&P, and actually the S&P's rally has overperformed the Dow Jones Industrial Average. All right. NASDAQ, similar to the S&P 500, they've all had this V recovery. But again, look at the volume. Look at the volume. Russell 2000. Look at the volume. Well, it's pretty average, but you notice even in the Russell, it corrected, but it hasn't rallied beyond the this point. Okay. So it's having a lower high in the rally. Lower high, lower high, lower high, lower high. Is a lower low coming next? Is a lower low coming next? For if Trump wants his way with the interest rates, that might be the best way to get there. But I basically what I'm saying is I think that the Wall Street stocks are overvalued. Even with you talk, they're talking about the S&P currently. If you use a 300 earnings, that it's trading at around 21 times what they are projecting for the go forward year. With all the economic uncertainty that's happening now, I think that there's a very high probability that that estimate is going to be too high. All right. So even if you use that estimate of 300 in earnings for the S&P 500, you're still trading at 21 times forward earnings today. So you're priced for perfection. And while you're priced for perfection, the CEOs on Wall Street that run these S&P 500 companies, they can't give you guidance on on their forward guidance for their companies because of economic uncertainty. And while they're unable to give you guidance based on because of economic uncertainty, they're also selling stocks at record pace. Okay, the insiders are blowing out their stock while retail and the other Wall Street stock bulls are buying, they're selling. All right, and ultimately they're also not hiring, and they're also unable to make plans for the future for capital expenditures, things like that, like build. If you are uncertain about the economy because of the tariffs and all these other policies, how are you going to then go and say, well, we're going to spend $2 billion to build a new factory? They're not going to. Well, are they going to hire thousands of people? No, in fact, they're laying people off. That's why companies are workers. It's at a record high for workers that have to take on two part-time jobs. So I've talked about this for a year and a half now, how full-time workers during Biden and now into Trump are losing their full-time jobs, their higher paying full-time jobs with benefits. They're having to take on two part-time jobs in order to make ends meet, and they don't have as high a paying, and they don't have all the benefits. And so no wonder the consumer is stretched and they're at this is at a record number now, folks, of workers that are taking on two jobs because they lost their full-time job. Now, of course, the Federal Reserve and the government statistics say, oh, well, you lose a full-time job and you take on two part-time jobs, you've created a job. No, you haven't. You've created a consumer that has affordability has just gotten much worse for that consumer, which is why you're not seeing any activity in the real estate market. The prices are high. There's no transactions happening. Credit card delinquency is at its highest. The consumer is stretched, stretched, stretched. And so, you know, this is not a good scenario to be buying Wall Street stocks. And that's why you're seeing this problem with volume. All right. And so all of this gets back to my big argument of why I think investors, they need to be out of Wall Street stocks They need to be out of bonds. They need to be out of US dollars. And if they got to be in stocks, they should be outside of the US looking for multinational companies that are, you're actually buying those at relatively inexpensive valuations. And so that's a better alternative. But the best alternative to me is in the gold, silver, copper, especially in the stocks of the companies that have exploration for new discoveries and have found important new discoveries, or developers that have high quality projects that are and miners, junior miners, mid-tier miners, major miners. They're all a terrific opportunity because if you look at the valuations relative to the valuations of all these assets, the metals, the companies that are involved in this, they're all trading at historically low. The companies are trading at historically low levels. Meanwhile, the metals are breaking out, and the valuations of these companies relative to other assets is at record lows. Do you, I don't think people are aware that during the Great Recession or the Great Depression and during the 1970s, stocks didn't do much for investors. You know what did? Gold, silver, mining stocks. Past is prologue. The past, we're in the 1970s again, folks. We're there again. And it isn't coincidental that when the federals or when the United States went off the gold standard, putting the whole world off the gold standard, it took 50 years to break the fiat currency and debt system. And before that, the world was on a gold standard. I think we're going back to a gold standard. I think you're going to see gold, as they do that, get up to $20,000 per ounce. That silver gets up into the hundreds of dollars per ounce. That copper goes into $10 or more per pound of copper because you've destroyed the fiat currency and debt system. So that's where I think investors should be. But that's not my decision to make. That's your decision to make. And the way you make that is by doing your homework and speaking with your financial advisor before you make any investment decisions. I'm an opinionated guy. I'm just giving you my opinion. Now, my opinion's based on 32 years in the mining business. So I've been watching these metals and markets for a long time. And I've got others on my side, which guys like Ray Dalio, you heard of him. Stanley Druckenmiller, you heard of him. Um, Peter Schiff, a lot of smart people that follow these markets for a long time that are much wealthier than me see the same thing that I'm talking about. So do your homework, speak with your financial advisors, and I'm just an idea generator. It's all up to you to make those decisions. Have a great